Thank you, Alex. Thank you, Danny. And thank you to Ralf Weber from Julius Baer, who joins us today. We really appreciate that he's coming and presenting Charles Schwab as an investment case. He's a veteran investor, has been at Julius Baer for over 20 years, and oversees a big portfolio of value investments about which he'll talk a bit in just a second. Thank you, Ralf.
Yeah. Thanks a lot. So there are now after me, 2 more speakers between me and the lunch, so I will speed up a bit to catch some time that nothing gets cold. Just a bit who we are. Bank Julius Baer. I think most people know Bank Julius Baer. It's the largest pure play wealth manager in Switzerland. Roughly 426 billion assets under management, approximately 1 billion profit last year. And one thing which is still special about Bank Julius Baer, although we have grown over time, I think we are still small, especially in investing, and so we keep the teams very focused, very small. And on the value side, for example, we were never than 4 people, always between 2 or 3 people with voting members. I joined Julius Baer in 2000, entered the special value team 2015, and since then we always developed the team further. When you look at our special value strategy, currently 4.5 billion assets under management, 1.5 is also is a public fund called Special Value Fund, and the rest is mandates for clients starting at 1 million. Then, quick look at our track record. We have strategy in 3 currencies, also Swiss franc and euro. But as we do some partial FX hedging, so we always hedge back 50% of the currency exposure for our Swiss and euro clients, it was better to show the US dollar performance. There you can see, since inception, we compounded money at 7.5. Like many value investors, we had also some struggling 15 until 2020. That's why we added also a value benchmark just to keep us sticking to a value strategy and do not style drift like some managers did and then regretted last year. Last year, we were down 4-5%, so we were clearly value. And when you look at the year-to-date performance, yes, we are lagging a bit the market, but I think for a value fund like we do it, up 6.9 as of end of April is still a very good number. What did we do in terms of strategy? I think at the beginning, when Ed Frauenfelder launched the strategy, we were more on the left-hand side, a bit similar like Warren Buffett being, so looking for cigarettes, buying them, and once they're up 10-20%, moving on. But the problem was it less and less as we worked, and as we also increased in volume, it was becoming more difficult. So over time, especially on the contrarian side, since the big disruptors appearing on the floor, like Amazon, most of contrarians there, they were priced for a reason. They were often value traps, and so we really reduced that exposure to roughly 5%. We still like classic value ideas, which is very flexible. So at the moment we have roughly 10% in energy, 5% in commodity stocks. We also own two of the higher-end German car manufacturer. So these are classic value stocks, decent dividends, and usually PE around 6-7 times. But I think one segment where we really started buying more value thing is a bit the Warren Buffett style, looking for the wonderful companies, the compounders, and then it was just our trick, just being patient, looking at them, and when they get out of fashion due to temporary problems, then we buy them. This is a bit what we do on that side, and that's also why I will present Charles Schwab today. Because the nicest thing, often something like SVB or Credit Suisse happens, and then everybody says, yeah, banks, I knew it, they're bad. So everybody's selling everything, and this can sometimes offer great buying opportunities. So Charles Schwab at the moment, it looks like a contrarian, it looks like a typical value stock, but when you look at their track record, it's still a wonderful company. They just have one problem. They have a lot of deposits, and they were refinanced at least over 5 years. So they had to take some losses on the balance sheet, but that's the only problem. And if the clients still believe in Charles Schwab, which they do actually, so the clients still adding more, bringing more money, the company gets even stronger, and it will just starting to reverse over time. So quick look at Charles Schwab. So the yellow line is EPS. It was compounding at 19% per annum over the last 10 years. When I look at stock performance, it more or less always caught up again, trading around 25 times earnings. Quite a decent price for a financial stock. But yes, it has much higher return equity than most of the others, around 15-20%. And then 18, it offered the first buying opportunity when everybody was thinking interest rate would stay at zero forever. And now, earlier this year, we got the second buying opportunity. So how is Charles Schwab making its money? Here I have just the business mix. The biggest bulk, although it started as a discount broker, it's no longer trading fees. Because when Robinhood and some others started offering for free, they said, we can do it as well. We don't need it. Because when you look at the dark blue line, they make most of the money with net interest margin. So just taking the cash which clients keep on the cash account and investing into risk-free assets like treasuries or mortgage bonds. It was around 60% in 18, and now it has dropped even to 40% 2 years ago or 1 year ago. One second. One thing which is amazing, so Charles Schwab, just remember Julius Baer, 426 billion assets under management. Charles Schwab is now nearly 20 times bigger than Bank Julius Baer, so it has a lot of leverage. And they're one of the greatest IT platform just to take in this money, reduce costs for the client, and repeat. And when you look at over time, they're taking now in at the rate of 200 to 400 billion in a year. So it's amazing. And it's the same again. Money comes in, people start investing 90%, 5 to 10% is more or less the average on cash. And on that cash, that's where Charles Schwab makes most of the money. Yes, this March, some of the clients were also fearful, but they did not run away, but they were buying treasury bonds, they were buying money market funds, and that's why some of the cash amount clearly came down from 6.5% to 5%. But when you look at the numbers, it's just huge. So client deposits, 430 billion, 13, and equity is only, so was at the beginning of the year, 56 billion. And now, after they took the loss on the balance sheet, it went down by 20 billion. And in our opinion, this will reverse now, and Charles Schwab is still highly profitable, so they do around 7 billion a year, so this should be only temporary. What was the problem? Already outlined. Now there are big alternatives. So if you have more than enough cash, you don't need to put it there. You can also put it into money market funds. But often, as the average client has only $20,000, so it's not just the millionaires or billionaires are there. So many, when they trade, they just keep some money on the cash. That's why we are pretty convinced that they will, more or less over the next 1 or 2 years, they will move back to normal. They will get more assets, and this will make the valuation very attractive. Here, just the bond book. How was the hit? So they're very open how they've invested it. So most was in agency mortgage and treasury bills, 4-year duration. But the hit was huge because they own 333 billion at the beginning of the year, of last year, and now it's 306 billion. But one thing, they don't want to do it. They don't want to sell it. That's why they're borrowing at the moment roughly 40 billion from the Fed, because otherwise they have to take the hit already. In terms of maturities, so you see well spread, 4%. And yes, in hindsight, they could have done better in 2020, just buy short-term treasuries and wait for yields to go up. But like most, I think they did not expect the move go so fast. So what's not possible? Or what could be worst case? I think if bond yields go to 8-10%, then Charles Schwab is ready for a capital raise. That's always the problem if you own banks, and then when they're down the most, they raise capital. But in our scenario, we rather think inflation will go back to maybe 3%. So 3% will be the 2%, so the new normal. And if you have 3% inflation, then I think the current level of 3.5%, 4.5% is pretty reasonable. And then it's a great opportunity for Schwab just to go back to normal and have decent earnings. How is the valuation at the moment? 14 times earnings. It used to trade at 25 earnings. And the interesting thing is, so this year the market is expecting earnings to drop 20% due to higher financing costs. But next year it should already start to go up again, maybe at 15, 20% a year. And what's then possible in terms of scenarios? If you take some P's, if you say 15 times earnings, so that's the trough of now, or 18, then we land around $80. So 44% upside. If you say people realize it, it's a great compounder. It needs 20 or even 25, then you can see the stock can even go up 90 or 140% in the next 3 years. That's the story of Charles Schwab. Any questions, if I still have time?
Yeah, you do. You were very compact and lots of interesting content in limited time. Thank you. So, who would like to go first for a question for Ralph?
Can you explain again, why are you not concerned that the 300 billion in deposits are not going out and not moving into money market funds? Because then they would be forced to sell more of their bond portfolio now.
I mean, you have the whole history. So Charles Schwab clients, they tend to own between 11 and 15% cash. More than half was always in money market funds. But a big part is what I said. So people buy something, sell something, and in the middle they keep it some cash. And maybe always going into money market fund. If you just do trade, it's still a discount broker. So many clients maybe do more short-term trading. So there will also always be some numbers there. And one thing which makes me more convincing, because once Schwab gets every year or every month new money, the number of just holding deposits will be even less in terms of assets under management. Yes, short term it's clearly risk when the Fed is offering 5.2% like risk-free money, but I think this 4 or 5% should stay. And for us, it was a very nice sign that client did not move out. So actually, they had one of the strongest inflow in March when SVB and Credit Suisse both failed or had to be saved.
Thank you very much. Is there another one? We probably do have time. If not, thank you so much. Thank you for coming.
Thank you.
And big round of applause. Thank you, Ralph.